Hi everyone, welcome to my channel MVS Edu. This is Dr. M.V. Subbarao, Professor in Commerce and Management Studies, working with Godavari Institute of Engineering and Technology, an autonomous institution in Rajahmundry, Andhra Pradesh, India. I hope you all feel happy watching my videos, and I also hope you all safe and healthy at your places. In this particular class, I am going to explain the concept of break-even analysis. What is break-even analysis and what is its role in a business organization, and what are the terms pertaining to the break-even analysis, and what are the assumptions of break-even analysis, and in the same manner what are the uses and limitations of break-even analysis. We see usually in a newly started business organizations, they try to attain the stage of no loss and no profit instead of thinking about earning profits. Moreover, it is very difficult for a newly started organization earning profits in the beginning years. So, all the business organizations, they in the initial years, they all usually try to attain the stage of break-even. What is then break-even? Break-even means nothing but it is a stage or a point where the firm earns neither profit nor loss. At this particular point, the total revenue of the firm is equal to total cost. What is total revenue? Of course, for any business organization, the total revenue means the revenue which is obtained on sale of commodities or by rendering service. This is total revenue. Similarly, total cost means the cost of producing commodities or the expenditure which is incurred on rendering services. So here the cost of production, it includes variable cost, fixed cost and some other cost. All these costs total is nothing but total cost. When the total cost is equal to total revenue, it is said to be break-even analysis. This is one way of meaning of break-even analysis. We have another way for explaining the meaning of break-even analysis. That is called broader way. In this broader sense, break-even analysis is nothing but calculating probable profits at various levels of output. Usually, any business organization, it produces the products or the commodities against the orders they received from the consumers. As long as they receive the orders from the consumers, they continue the production. That is why consumers never give similar orders. One consumer may give some quantity of commodities and another consumer may give another quantity of commodities. Like that, from consumer to consumer, the order of commodities will vary, so that the organizations will produce the commodities according to the orders they received from the consumers. And first of all, the organization, they prepare a schedule basing on the orders received from the consumers. As per the schedule, they go on producing the commodities. It is quite natural at a particular level of production, the organization earns a particular amount of profit. In the same manner, in another particular level of production, the same organization earns another amount of profit. So, in such a way, depending upon the production, the profit varies. So, here the break-even analysis in the broader sense is nothing but calculating the probable profits at various levels of output. The break-even analysis is based on some set of assumptions. We will see now one by one. First one, the total cost may be classified into fixed and variable costs. It ignores completely the semi-variable cost. And the second one, the cost and revenue functions remain linear. Thirdly, we have the price of the product is assumed to be constant. Next one, the volume of sales and volume of production are equal. And fifth one, the fixed costs remain constant over the volume under consideration. Next we have, it assumes constant rate of increase in variable cost, and it also assumes constant technology and no improvement in labor efficiency. Next, the price of the product is assumed to be constant, and after that the factor price remains unaltered. And next one, the changes in output prices are ruled out. And finally, in the case of multiple product firm, the product mix is stable. These are the assumptions pertaining to the break-even analysis. I may now mention some important limitations which are to be kept in mind while using break-even analysis. First one, in the break-even analysis, we keep everything constant. The selling price is assumed to be constant and the cost function is linear. In practice, in fact, it will not be possible. Second one, in the break-even analysis, since we keep the function constant, we project the future with the help of past functions. This is not in fact correct. Third one, the assumption that the cost revenue output relationship is linear is true only over a small range of output. It is not an effective tool for long range use. Fourth one, profits are a function of not only output but also of other factors like technological change, improvement in the art of management, etc., which have been overlooked in this analysis. Fifth one, when break-even analysis is based on accounting data, as it usually happens, it may suffer from various limitations of such data as neglect of imputed cost. Arbitrary depreciation eliminates and inappropriate allocation of overheads. It can be sound and useful only if the firm in question maintains a good accounting system. Sixth limitation, selling costs are specially difficult to handle break-even analysis. This is because changes in selling costs are a cause, not a result of changes in output and sales. Seventh one, the simple form of break-even chart makes no provisions for taxes, particularly corporate income tax. Eighth one, it is usually assumes that the price of the output is given. In other words, it assumes a horizontal demand curve that is realistic under the conditions of perfect competition. Ninth one, matching cost with output imposes another limitation on break-even analysis. Cost in a particular period need not be the result of the output in that period. And finally, 10th one, because of so many restrictive assumptions underlying the technique, computation of break-even point is considered an approximation rather than reality. Uses and advantages of break-even analysis. First one, it helps in the determination of selling price which will give the desired profits. Next, it helps in the fixation of sales volume to cover a given return on capital employed. The break-even analysis helps in forecasting costs and profit as a result of change in volume. The break-even analysis also gives suggestions for shift in sales mix. It helps in making interfirm comparison of profitability, and that means we can make the comparisons in between the firms of one organization regarding the profitability. Next, it helps in determination of costs and revenue at various levels of output. I have already revealed that the break-even analysis is nothing but calculating the probable profits at various levels of output. The same here, it is coming as one of the advantages of break-even analysis. Next, it is an aid in management decision making, forecasting, long-term planning and maintaining profitability. Next, finally, we have it reveals business strength and profit earning capacity of a particular concern without much difficulty and effort. Finally, I can say that break-even analysis plays a major role in the business decision making. Sometimes the business people take decisions basing on break-even analysis whether to accept or reject for the production of a commodity, and similarly basing on break-even analysis the business people also can take decision on make or buy, whether to produce the things or products or to buy and sell the products. This is about a brief lecture on break-even analysis. I hope you all understood well. Thank you.
Subscribe now and press the bell icon. Never miss an update.